Everybody, and welcome to another July edition of the Market Update for 2020. So, funny story. Today I was actually supposed to be at my other job as a before model for barbershop photos, and it fell through. So the KW Connect people said, why don't you come on and do a quick update to the Market Update? So here we are. So we're going to do a quick look today at a couple of new numbers that come in, and I want to take a look at some of the questions that I got from the last market update and sort of how they frame, what we think of the market for the months to come. So since I just did the July numbers, the June numbers for the July update last week, we're not going to dive into those a lot. It's available on Connect on Demand if you'd like to go see it. And I'd encourage you to. There's a lot of really cool information in there. But so we're not going to spend a lot of time on that today. Instead, what I want to focus on are a couple big questions. So let's get into it. As always, feel free to use this as part of your presentations to your clients to inform, to help educate them about this crazy market that we're living in right now. And we have Slido going right now. So if you have any questions, send it out on Slido, and I'll do my best to try and answer it. So here's what I want to think about today. In my mind, here are three big questions for the housing industry. And, spoilers, I'll tell you right now, if you're looking for answers to those questions, I don't have them yet. So I'm not going to be definitive. But I do want to point out some of the data points today that I think are pointing honestly in contradictory directions. So we've got points for and points against. So we'll talk about it a little bit. But first and foremost, so right now, I think from a national level and most of the regions that I've looked at, we're in just an incredibly hot market, really hot. And we'll talk about that in a little bit. So is that current market a continuation of the hot market that we saw pre-pandemic? So building up through the latter half of 2019, January and February are both great months before COVID-19 hit. So is it a continuation of that? Or are we simply seeing a boost from pent-up demand from the lockdown? So all the people who really weren't able to buy or didn't feel comfortable buying maybe in March and April and parts of May, are they coming out now and we're seeing that swell the numbers? And I want to be clear, it's not necessarily an either or. Almost certainly there's elements of both in there, but where that balance moves really depends on what we expect to see for the rest of the year. If we're back into the hot market, then we expect these numbers to be up, year over year for the rest of 2020, barring a change in the circumstances. If it's mostly pent up demand, then we'll burn through that and we'll settle down some level where we don't know. So the second question, how will the recession affect the housing industry? We are in a recession right now. I'm going to, even though I have no information, I'm going to show you the GDP number later just to really drive home the fact that we are in a recession. And, recessions obviously affect people's spending, affect their economic security, whether they can get a mortgage, whether they feel comfortable getting a mortgage, all of that really comes into play. And how much is that going to affect the housing industry? This is very much not like the last recession. And we'll talk about that in a little bit. But we can't just look back to the period of 2008 to 2012 and say it's going to be like that, or even the recession before that in the early aughts. This is really an unusual circumstance. It's both deeper and narrower than what we've seen before. And then lastly, and I want to be clear, we're not going to spend much time on this one today, but it's hugely important, is how will the ongoing pandemic affect the housing industry going forward? Obviously, this is outside of my area of expertise. Many will say that the other two are outside of my area of expertise, but I'm still going to stumble on those. But I'm not going to try and talk about the pandemic at all. But here's the thing. Most municipalities at a county level, at least in the U.S., have a dashboard that they've set up or somewhere where they're reporting case numbers in their area. Honestly, I keep the one for Travis County where I live here in Austin up on my computer all the time, and I'm checking it daily. This matters. So if you see a spike in cases in your area, especially a spike in hospitalizations, generally that's what a lot of municipalities look to trigger response. So it could bring further lockdowns. On the other hand, if you see the numbers shift, it could ease the lockdown measures. People could get back to work. businesses that maybe were affected could open up. So this is really important. And you've heard me talk in the past about, the importance of matching up the national numbers in real estate with your local numbers in real estate. And that hasn't changed. That's still hugely important. But I'd say in this area, really the national number for COVID-19, it practically is meaningless. What really matters is your local area, the responses, the degree to which people have been infected, the path forward for COVID-19 varies widely from market to market. So you might live in an area that's really barely been touched, or you might live in an area that was massively impacted. And what sort of lockdown you have, how real estate's carrying on, how comfortable and confident people feel, all is different. So you need to pay attention to those numbers. Find that dashboard, Google it. That's the easiest way to find it. Check with someone else contact your city. Almost certainly has resources available for you, but pay attention to that. Just a few moments a day, checking that, keeping an eye on it, gives you a real indication of what may be happening in your local market. So, the housing market. So I want to recap very quickly, nothing to add to these numbers, the existing home sales number, or the sales numbers that we talked about last month. So for June, again, the June numbers, the most recent one out, existing home sales in the US were at a seasonally adjusted annualized rate of 4.72 million. That was up very sharply, a record increase on a monthly basis from a terrible number the month before in May. So up 20.7% month over month, but still down 11.3% year over year. And we talked a little about the problems with doing seasonal adjustments during the pandemic and the way the data is being thrown off a little bit. If you look at the non-seasonally adjusted numbers, it's actually closer to only 3% down. But either way, we're still trailing where we were last year. Now, in Canada, home sales were at a rate of 41,741. And, just booming. So they're up 62.9% from the prior month, but look at that, 3.7% from the prior year. So Canada is already ahead of where they were last year. They've recovered from the drop that they faced, the same as the US during the pandemic, and are already up above that. And that's fantastic. So for all of our Canadian associates out there, congratulations. You're back at a really good looking market. I'm really anxious to have the Canadian Real Estate Association start doing their forecasts again. They stopped it during the pandemic, saying that there's just too much uncertainty for them to do it. But I really want to know what they think of this and how the year is going to go. But that's a great number. And then back in the U.S., new home sales, look at that, 776,000. That's already back up to the peak where we were right before the pandemic. It's up 13.8% from the prior year and from the prior month, and 6.9% from the prior year. That's fantastic. We've been working to get back up to these rates ever since the Great Recession, when construction was so hugely impacted in the US. And that is good news for the inventory issues that we have, for affordability issues that we have. And I'd love to see that. Construction lags a little bit, but some of the indicators that we talked about last week on construction look great as well, especially builder sentiment, which is almost right back up to where we were prior to the pandemic. So what does all this mean? So I'll tell you the number one thing I'm looking forward to right now, which now that I say it sounds incredibly real estate geeky, but is the NAR numbers for July. They won't be out till later in the month, but I'm really anxious to see what we're seeing. To what extent are sales going to get back up above? Will they get back up to where they were last July? Will they go above that? Our chief economist, Ruben Gonzalez, constantly reminds me, and I keep having to be reminded, that we're probably not going to see the full effect of the spike in cases back in the late May, early June period until the August numbers. But even so, we're really anxious to see what the July numbers are. And we have a couple indications that they will be good. So here at Keller Williams, we've already got our numbers in from June production, and it's not official yet, so I don't want to give the number, but it's phenomenal. We're up in closed units, double digits from the prior year. And that's just fantastic. So a double-digit percentage from July of 2019, which was a good month. So it's a crazy number, not at all what we were thinking when we were forecasting this out back in March and worried about what could happen over the course of the year, it's great to see. Again, it's not official, so I'm not giving the actual number. That should be out fairly shortly, but it's a great indicator. Now, again, that's Keller Williams. We often outpace the market, so that doesn't necessarily mean NAR will be up at a comparable pace, but that's still a good indicator. So in preparation for this session today, I went out and looked at MLS data for the month of July and took a look at 20 big cities across the U.S., just an informal look, and about 75% of them were up in sales on a year-over-year basis, which was great. That's not what we had been seeing, to say the least, over the prior months. So that was really strong. Some of them were significantly up, again, back in double digits. And that was, again, just for the actual city. Later, when I have more time, I'm going to take a look at broader MLS areas, but it's still a good indicator that, this really is a broad-based hot market. Obviously, that's at a national level and in a lot of cities. Some were still down year over year, and your individual market may not be quite as hot as what I'm talking about, which again comes back to why I really, really encourage you to know your local numbers to match up what I talk about here. But it was still a very, very good sign. And I think there's one thing that really I like to see is been tracking new listings. And that's really been the most disappointing thing to date. Inventory is really low. And, as we went into this year, before COVID-19 was anything any of us were really focused on, I'm pretty sure if you go back and look at the videotape, you'll see me talking about my big concern for the year was that a shortage of inventory would act as a drag on sales. And I was very optimistic at the beginning of the year as construction ramped up and as new home sales up. But I was still worried that that new inventory would keep sales from growing as far as demand would like to push them. And so imagine my surprise that even after the pandemic, we're kind of back in that situation right now. New inventory has really been a constraint. We were at 4 months at a nationwide level last month in June. And when we looked at individual cities, it wasn't uncommon to see 1.2 months, 2.1 months. It was really, really tight, especially in certain segments of the market. So having new listings trailing where they were last year was concerning. So we saw a big spike in activity. Again, just for this informal look at the cities, that same group that I talked about, 75% of them were up year over year in total sales, were also up, not the exact same ones, but about 75% in listings. So new listings in July 2020 were up over July 2019, and some of them by significant double digits, 30%, 35%. And we had not been seeing that during the pandemic. And, I think what that shows is that at some extent, things are getting back to normal. And by that, I mean sellers who want to sell are moving forward, buyers who want to buy are moving forward. And I think in large part, and I've said this before, it's a testament to all of you adapting your business models to reflect client concerns during the pandemic, to incorporate recommendations as to how business can be handled safely, to using the technology that KW is providing to showcase properties virtually, to be able to do video tours or virtual tours, to really adapt our business models to the environment that we're all living in right now. So that's really good news that we're seeing listings come up. And I've said it before, 1 month is not a trend to make, but that's a really good sign. And if we're looking for indications that this is not just simple pent-up demand, we need to see that additional inventory if we want to sustain this hot market into the late summer and fall and winter period. Now, again, we'll see traditional seasonality. I'm really glad to say that, to be honest. I didn't know back in March if we'd see traditional seasonal patterns. So we'll likely see sales go down a little in August, go down a little bit in September, like we always would. But if we can keep those year-over-year growth rates going, then that's a sustained market, which is fantastic and good for all of us. But a key piece of keeping that together will be the new listings that we're really glad to see. So, and two other things I guess I'll touch on really quickly. If we're talking why sales are doing so well right now, and I feel bad even saying this, but we're going to talk in a minute about unemployment, and unemployment is just massive and terrible, a national tragedy, and really, in my mind, one of the biggest threats to our economic recovery and ongoing health of the housing market. But unlike other recessions, unemployment has been both deeper and narrower. So it's very focused on right now face-to-face businesses, which are largely in the hospitality and leisure categories. And as a rule, again, just as a general rule, it's not an absolute thing, they tend to have people who are slightly at the lower end of the pay scale and maybe not the prime homeowner demographic. So it's an absolute tragedy that these people are out of work, but they're more likely to be renters than homeowners. So I think I would normally expect to see more of an impact of double-digit unemployment on housing sales, but because of the way things are falling out during this weird recession, I don't think it's having the same impact that it has had. Now, that could change. Either as potential unemployment widens if things get worse and eat more into white-collar jobs, or as mortgage forbearance and the extended unemployment payments have ended, that people are forced to sell. I said this last time, if that comes up, I don't think we're looking at a revival of distressed sales. The number of underwater homes right now in the U.S. is very, very low, and the vast majority of homes have some sort of equity in there and would be able to pursue a traditional sale, which is great for them. They won't have to deal with all the negative consequences of a foreclosure or a short sale, assuming a bank would even consider a short sale right now. But it might mean a flood of sales onto the market, and that would be both an opportunity and challenging at the same time, could drive prices down. So we don't know what's going to come out of that, but right now, unemployment isn't hitting the prime home buyer demo, and it hasn't had as big an impact on sales as you would expect for that. And then lastly, I think, as I said earlier, people are adapting, but I think there's an element of fatigue in there too. And I hope that means that they're not just ignoring safety guidelines and pressing ahead with things they want to do. I know there's some of that. I'm a realist, but hopefully there's not as much of it, especially in our industry. So, because that would simply lead to more cases and more potential for further lockdowns and further economic disruption, which would be bad for all of us. So again, those are some of the reasons why we think what we're seeing in home sales and why the market's so hot. And fingers crossed that all the good things I was talking about are what's going to come to pass, and we can extend this market into the fall. So the unemployment rate. So we're going to talk a couple of unemployment numbers right now, and these are really the only new numbers since we last talked last week. So that came out just today, as a matter of fact, or maybe it was yesterday. July's unemployment rate was 10.2%. That's down actually a little from 11.1 the prior month, and up drastically, no surprise there, from the 3.7% last year. And our neighbors in the north, in Canada, we'll get back to those in a moment, are seeing a 10.9% rate. Again, this is also the July number, down a little from 12.3, and again, up from 5.7. Now, unemployment in Canada is a little bit different in the U.S. Their number tends to be a little higher than ours. That 5.7, for example, last year was a great number. So the fact that they're at 10.9 is actually, they're probably doing a little better than we are in this situation. I'd attribute that maybe to they've had a better experience with COVID-19. I think they probably handled it a little better on a consolidated national basis than the United States did. But they're reaping some of the benefits from that now in the hot market that we saw earlier. That's already back in June up year over year. And I think the unemployment rate, as they loosen some of the lockdown measures, is probably on a comparable level, a little lower than we're seeing in the U.S. So I think there's good news and bad news in unemployment. And the good news is, that number's not as bad as it could have been. It's a horrible number. But as we saw last month, as the lockdowns eased in June and as cases started to skyrocket, we had concerns that could cause additional lockdown measures, which happened in Texas, where I live. All the bars and some of the restaurants are closed down again. And we saw initial jobless claims tick back up, which we'll look at in a moment. And we're worried that it could drive the overall unemployment rate back up. Now, we didn't see that. It still fell this month from 11.1 to 10.2. Now, for comparison, we're still higher than we got during the Great Recession. So this is a terrible, we made a lot of progress down from the near 15% that we hit back in March and April, but this is still a terrible number, and we need to get it further down. But again, it's not as bad as we thought it might be. What this means probably is that even though we are seeing more people filing for unemployment claims, and anecdotally we're seeing businesses close, more people come out, what's happening is new jobs and people returning to their existing jobs is offsetting that, so that we're able to see, likely, obviously we don't have stats on that right now, but that's probably a good interpretation of what's going on, which allows the overall unemployment rate to continue down. I don't want anyone to see the negative trend from near 15 all the way down 10.2 as meaning in any way, shape, or form we're out of the woods. This is still one of the biggest problems we're facing. And as I said earlier, probably the biggest threat we have going on right now to the ongoing recovery and the housing market. If we see this rate stagnate and stay in double digits or near double digits for extended periods of time, that is going to slow down the economic recovery and inevitably have an impact on the housing market. So we really want to see progress here. Now, I said earlier, we've seen a turn in initial unemployment claims. And this week, we've seen them tick up for a couple of weeks. It's back down a little this week, so I feel good about that. 1.186 million people filed for the first time. That's what it means, initial unemployment claims for unemployment. And that's down from 1.434 million the prior week. And look at that, up from 214,000 this time last year when unemployment wasn't really an issue. We were near record low levels of unemployment. So, this is not good. These are people losing their jobs and moving on to the unemployment rolls. We'll talk about job creation in a minute, but this works against job creation. We really need to get these numbers down. These are record levels that we've never seen before, and so it's still ongoing. And I say this because I want you to see that this is what the magnitude of this crisis is. It's one thing to see a 10.2 number and not really know what that means, especially in context if, like most people, you don't track this from month to month. But that means 1.186 million new people lost their jobs, or I should say filed for the first time for unemployment. So at some point recently just lost their jobs. That's a tragedy, and we need to get that fixed. The fact that it's down from 1.34 is a very cold comfort to all of those people. Now, once you've filed for the first time, you obviously don't count in this category anymore. What they do is they track continuing unemployment claims. And right now, 16.11 million people in the United States are filing continuing unemployment claims. Again, that's down a hair from the prior week, where it's 16.95 million. But look at that. A year ago, it's just 1.72. Which really, there's always going to be, no matter how great the economy is, there's always going to be people who transition, people who've lost a job. What unemployment is really set up for, to help them as they transition into a new employment role. And so that 1.72 number is one that the economy can deal with very easily. 16.11 is just amazing. And that's going to have an impact over time. And we have to hope that we can get get the recovery, keep the recovery going and move it forward. So I talked a little bit last week about continuing stimulus measures. And I don't want to get political at all. So I'm going to approach this just from an economic standpoint. So all of these people who are now not receiving those extended unemployment benefits, what that means is they are spending considerably less. And we're going to go to GDP in just a moment. But I want you to remember that consumer spending is the biggest part of GDP in the United States. And all the money that they no longer can spend because they don't have is no longer going into GDP. So we're not going to recover as fast. And you have to remember, this is, I'll steal a quote from Paul Krugman, my spending is your income. Your spending is my income. That's the way our economy works. When you spend $1, it's not just gone. You haven't just used it up like burning a gallon of gasoline. That goes to someone else who then spends it, who goes to someone else who then spends it. So pulling all that money out of the economy from an economic standpoint is scary a little bit in terms of our recovery. In our specific world, what this means is a lot of people aren't able to pay rent. and at some point will not be unable to pay mortgages. Now, it takes a little longer for that to filter in because forbearance is still ongoing in many cases, and for the bank to step in and take action will take a little while after that. But that's a looming issue that we have to pay very, very close attention to. Purely from an economic standpoint, additional stimulus or additional work would very much help all of us right now, just in terms of economic recovery. So we're anxious to see what comes out of that. But this is a crisis that, it's a ticking time bomb really in our economy right now that we have to be very, very, very concerned about. So we'll talk a little bit about job creation, and we want to see this. We want to see jobs keep coming back into the market. Remember, we lost over the first 2 months of the pandemic over 22 million jobs. And I'm going to repeat that because it's a number we've never had before. 22 million jobs. So essentially, all of the jobs we created since the last recession were wiped out in the space of 2 months. Gone. So we got to get those back. And we've seen a couple of months of really good growth. About roughly, I just seem to remember, 2.5 million new jobs back in May and 4.8 million last month, which is great. So that's slowed a lot this month, and that's a little concerning. Right now, we would want to see it still getting back to where it's being in leaps and bounds. If it stays at this lower rate, it's going to take a lot longer to get back to where we were. And don't get me wrong, we're not going to recover all these jobs in the next 3 months, no matter what. But really would like to see them coming back online faster than that. And that's going to be a challenge. One of the things that we don't have a good handle on right now is how many businesses that closed during the pandemic closed for good. There's a widely quoted stat out there right now that Yelp says that half of all the restaurants that closed are never opening again. I have no idea if that's true. I don't know whether Yelp employs statisticians to come up with that. But regardless of whether that number is actually right, it is showing what an issue that we have there. A lot of those businesses that close will never open. And it may be 20%, it may be 60%, it may be 50%, who knows? But that's a problem for our economy. And that means that we probably will have an elevated rate of unemployment for the foreseeable future, and that's going to be a challenge. So I talked a little bit about gross domestic product, and I'm going to show this again because this is just an astonishing number. In the second quarter, our economy contracted at a rate of 32.9%. We've never seen anything like that before. As a comparison, last year, it was actually growing at a rate of 2%. And even in the first quarter of this year, where the pandemic only really hit for the tail end of the last month, it was only falling at a rate of 5%. And to put that visually, that's what that looks like over the past 4 years. We've never seen anything like that before. That's the hole that we have to dig out of. So when I talk about the economic recovery, that's coming back from this. And that's absolutely essential. Staying at really depressed rates will affect all of our lives in our industry and just being consumers in an American economy. So last thing I want to touch on right now is mortgage rates. And these are the stats from June, 3.16%, down from 3.23 the prior month and down from 3.8 the prior year. But since then, rates are continuing to fall. Per Freddie Mac, the average rate for a 30-year fixed this last week fell to a record low of 2.88%. Never seen anything like that before. You're hearing stories all the time of people able to lock in refi rates below 3%. Crazy rates. Very, very low. But maybe there's some indication that low rates might not be enough. Purchase mortgage stats fell 2%, or purchase mortgage apps fell 2% last week from the prior week. Now, they're still up 22% from the prior year. We're in a hot market, but that's the second week in a row that they fell. Now, I don't think it's an inventory problem since we're seeing new listings come on the market. And if I'm pessimistically looking at things that we're just dealing with pent-up demand, this would kind of point to that. So again, I have no definitive answers for you today, but these are the sort of things that we have to pay attention to. Total volume of mortgage apps, refi and purchase, were down 5.1% from the prior week, but again, up year over year. So this is something we have to watch. Are we seeing it? Are we seeing it cool? Are we seeing it not? It'll be very interesting. So that's really the high points that I wanted to hit today on our very short extra edition of the market update. The last thought I want to leave you with is, and I've said this a lot, and I'm going to keep saying it a lot, we're not out of the woods. As the July sales numbers come in, both in your market and nationally, they are going to be good. In a lot of cases, they are going to be great. Don't let that fool you into believing that we're out of the woods. You want to keep doing the things that you've been doing to cope with this pandemic. You want to keep your fixed expenses low. We could have a double dip recession. We could see the housing market numbers go down. Now, you're in a hot market, so a variable cost that you can directly link to what you're seeing in terms of production, sure, you can do something in there, but I'd keep your fixed cost low so that if the market does come down, you're not suddenly burdened with an expense that you can't manage after you just made it through the last couple of months. You don't want to see October and November crater your business. Secondly, keep focus on lead generation. Listings are up, but I don't know if that's a trend yet. So you need to get as much business as you can. So really, I'm telling you a great prescription for any market. Keep fixed expense low and keep focus on the lead generation. But more than ever, that's really important right now. And I don't want anything I've said in terms of the great numbers that are coming out there or that you see anywhere else to make you feel that we're out of the woods and it's just smooth sailing from here. We really hope it is. And it is possible that it will be. But on the other hand, there's a good chance that it might not be. So stay safe, take care, and I'll see you next time on the Market Update, and look for me at the barbershop. Take care, everybody. Bye-bye.